Okay, so the agenda, we'll go through an introduction, but in a moment we'll be looking at the learning outcomes for this webinar. However, in summary, I will discuss why a firm should consider using Cashflow and the considerations in implementing Cashflow, and then look at ways Cashflow can be used to help the client understand their journey and to help you jump through some of the regulatory hoops. So to introduce myself, my name's John Bethel. I'm a business consultant with IRESS. I've been with IRESS, about 18 months now, but I've been in the industry for something like 30 years. I guess my background is kind of broker consultant, IFA administrator, paraplanner, advisor, and then latterly I ran the Cashflow proposition for a national wealth manager. So very much financial planning background, and that's where I see Cashflow sitting, one of my favourite hobby horses. So let's look at the learning outcomes briefly. I was told I had to put this in the agenda. All good. And really, I think what I hope you get from this is an understanding of how Cashflow can be used as part of your general offering and where it sits, how you can show your clients some really good outcomes. And that's what, for me, it's all about. It's all about the client. Moving on and looking at, I guess the area of defined benefits, it's always been a contentious area. I think it will always continue to be a contentious area. So looking at the ways that Cashflow can help you deliver the defined benefit transfer advice, maybe building some protections for the future there by having the correct scenarios can really help. There's a few other areas increasingly coming through from the FCA where it's suggesting that Cashflow could help, and I just draw some of those out, and that includes risk profiling. So for me, if I was sitting in a business saying, why should I be using Cashflow? I think you need to start at what does your business want from it, because every business is different. Are you looking for standalone revenue? Are you looking for an ongoing revenue stream? Do bear in mind that when you're looking at, say, a one-off charge, I wouldn't start work on it with a client for less than £1,500, and depending on complexity, the fee would increase from there. So it can be a useful source of standalone revenue. Or are you looking to have a slightly different approach and take it into perhaps your annual review package to produce an ongoing revenue stream? So are you going to charge extra for your revenue stream there? Or are you going to actually just incorporate it to boost the strength of your annual review? And certainly it changes the annual review discussion when you start using Cashflow. So really looking at that review, again, I think it's really important as a business to decide exactly what you are going to deliver. Do all your clients receive a Cashflow every year? Or do you segment your clients? Do you say that your higher tier clients get a full in-depth Cashflow with planning scenarios and any planning opportunities highlighted, whereas perhaps for the lower value clients, you just use Cashflow, a single scenario, a current position. This is where you are now projecting forward, and just use it as either a disturbance tool or a comfort tool to say, yes, you are on target, everything's fine, the planning's working, or actually, no, we've still got negatives there, we need to deal with that. In terms of the business side of things, I think it's also then important to look at what are you doing within your business? How do you want this to work? Do you want one system within your business, so you're dealing with one vendor, or are you happy to work with multiple vendors? I think I've seen the benefit of having the kind of the standard one system. That means that it's one system from fact find through to your client management system through to Cashflow. There's some real benefits in terms of not having to rekey, in terms of data management as well, that makes the one system view attractive from a business point of view. The next point in terms of business I'd look to consider is, how as a business are you going to deliver the output? What are your requirements? What I mean by that, is this going to be, is the output of your cash flow going to be based around paper, around a cash flow report, which you can send to your client? You can then discuss that with the client, set scenarios, and it's very in control, and the client has something that you leave them with. Are you going to integrate cash flow into your suitability report? And so I guess probably the best example of that I can give that makes it very, very obvious, in a protection environment, if they have a shortfall, they clearly need some life cover, so you can put a cash flow chart at the front end of the suitability report and say, this is your current position. You know, your family will run out of money broadly in 20 odd years' time. Here's the advice. So take out some life cover or whatever it is, and then a second graph that says, and this fully supports the solution, or actually there's still a shortfall because we are cost bound, or whatever the reason is. So you can absolutely describe that within your suitability. The final part of sort of the business element of this is to consider the scalability of it. The power of cash flow really comes through when we look at repeating this year on year, so the client can see that progression. And so that means you have to have a process that is swift, efficient, and delivers what you need, rather than that may actually temper what you're tempted to do initially, and we're very happy to guide you through that process. Cash flow outcomes. Inevitably, we know that a visual output for most clients will have a greater impact than the written word. And so being able to model their scenario and show them in graphical form is a really clear, quick, and easy way to show the client the issues. It also allows the planner to have built a second sort of scenario, if you like, which means that they can then show them the benefits of the course of action that's being recommended. This again will just lead to that greater engagement from the client as they discuss the inputs, the outputs. And so it then becomes much more about the client's objectives and being able to assess those client objectives rather than a pure investment related discussion. One of the points I'm going to make here is about the graphs that you use with a client. It's key to remember that we see you will see cash flow graphs year in, year out, day out on a regular basis. And so you will be able to look at a chart after a while and say, yep, I know exactly what that means. And that's fantastic. But remember, the client doesn't see that. The client sees the graphs maybe once a year. So it's a question of them being able to understand quickly and easily what that graph is saying. So in a moment, I'm going to move through into one graph. I'm just going to pause for a moment to allow you to look at it and to decide what that graph is telling you. Remember, your first thoughts on this are likely to be very similar to the first thoughts that your client has. Okay, so what do we have here? We have a very basic graph here. Blue is good, red is bad. So we can see in the early years, the assets are rising up to retirement, they're then falling away and running out of money broadly in their mid-late 70s. And I always use that as a description. I would never be precise about you're running out of money at age 78 and a half or whatever else it is, because this is a series of projections. We have assumed what the growth rate is going to be. We've assumed what inflation is going to be. We've assumed what the client's income is going to be, and probably most volatile of all, we've assumed what the client's expenditure is going to be, because that, I found, changed regularly over time. And so it's a series of assumptions. Therefore, while we calculate really accurately, we actually display relatively broadly. So it's all about that repetition I mentioned earlier and the direction of travel, rather than an absolutely accurate and precise science. The next chart, maybe we've tweaked some bits and pieces to make the outcome clearly much, much better. And that's kind of the benefit of having that dual scenario approach that gives you the second scenario that has the planning in it and shows why they should be paying for your advice. Certainly, as a client, I'd rather have the second chart over the first. So clearly, I'll be prepared to pay for that. That said, with charts, it isn't always about simplicity. So when I look at this sort of chart, a lot more complex. However, there's real value in these. Certainly for you as a planner, I can now see exactly what's going on in terms of expenses. I can see that orange area, the amount of tax being paid. Is there anything I can do to mitigate the tax being paid here? If I look very carefully in this scale, I can see along the bottom there, there's some more income tax being paid. Is that something that I want to plan around? Are there other things I want to do? So the more detailed charts are really great for planners, but also in time for clients. And so where I might be taking my client on a journey in terms of this is the financial planning, I've used the straightforward graphs we've seen earlier just to work that through. In time, 2, 3, 4 years down the line, it may be a question of bringing in slightly more complex ones if they are able to take that on board. And so I guess the summary of this is to say, simple charts, certainly to begin with, there may be times where more complex charts are useful. But just bear in mind what I said at the start of this section about thinking about what the client sees first of all and your first impressions on a cash flow graph. I've alluded to having different scenarios when looking to display for a client. And for me, it's certainly initially with the client, it's about that current position first of all. And that current position is, if the client doesn't take any further advice, where are they likely to end up? What's their direction of travel? So, for instance, looking at what happens to if they have surplus money each year, what does the client do with it? If the client doesn't have enough money each year to support their expenditure, where do we take that from? My experience says clients with surplus money do one of two things. They either save it, and so it rolls up in a deposit account if they don't have any other advice, and you'll be able to see it there in their deposit accounts. Or they think they have spare money, they save it month on month, and then at the end of the year, they go and buy a kitchen, or they go and buy a car, or they go on holiday, or whatever it is, because they feel affluent, and the money then won't be on deposit. And so, in that current position, you might be saying, actually, do you know what? We're going to have you spending that money, or we're going to have that extra money going on deposit because that's what you're doing now, and this is what your outcome looks like. So that's the current position. Then building in a planning scenario, which shows the solution. It shows our financial planning. And as we can see on the screen here, I've built this up and just said, well, actually, first of all, I'm going to take any money and pay off debt. As per the SCA hierarchy of need, that's probably what they'd expect us to do in most situations if your client has debt. And then I'm working through this fairly standard financial planning tax efficiency contracts. So looking after that, I'm then going to put surplus money into pension contributions and pension funds and get the tax relief, etc. So I'm going to make that money work harder. Similarly with ISA contributions, and then into invested assets so that I can then start using CGT allowances later, etc., etc., etc. So I can build up what my financial planning might look like. Then when we get into deficit, that current position, if we were to ask the average person in the street, what are they going to do with their pension at retirement? I would suggest that the normal expectation would be that they would take the benefits of retirement. And so that's maybe what you do in your current position. You set it up to take the benefits, take the tax-free cash, take the maximum sustainable level of income to the end of the scenario. We can then go for perhaps a slightly more sophisticated drawdown in our planning scenario that might say, do you know what, I'll even go as far as turn off the standard pension income, pension drawdown income or whatever, until it's needed. And so here in this order, I'm working through cash-based assets, then ISAs, and then through bonds at 5%, because that's nice and tax efficient still. And then I'm starting to pay maybe some CGT and then going to bonds at 100%. And at that point, I then pick up the pension drawdown. And so what that will do is it means that you are likely to extend the life of their money. So their money will last them longer. And in the example we have here, the reality is they would have run out of money in their mid-late 80s, and actually it extends to the end of the scenario, so for another 10 odd years. So that's, from a financial planning point of view, a really good outcome. But the other point you can make with your client is that, okay, that's fine if they survive to the end of the scenario, whatever that projection age is. But also, if anything was to happen to them in the meantime, from a tax point of view, because a lot of the money is then left in the pensions area and not in other assets, of course, that's really efficient from an inheritance tax point of view. So, and that's why, for me, this area of being able to allocate monies to different pots, being able to withdraw money from different pots at different times, to me, is really important in the financial planning process. I think many of us are quite comfortable with working with suitability reports and so going through cash flow reports is very similar. The only piece of advice I would give is make sure that when you have a graph that has a spike, you know exactly what's behind that spike, so you can explain that to the client. But if I was doing this interactively, so I've got the client sitting there, there are a couple of points that come out really strongly. The first of all, you have to know exactly what's going on in each scenario you're presenting, because you have to be able to answer those questions. And if you're moving things in real time, you have to have a real feel. So for those of you who aren't doing that right now, I would suggest that practice is key here. So first of all, I'd want to confirm the information that the cash flow is built on. And that means that when the client sees a graph, they don't come back with the question, so what's in that graph? They know. We can then look to see in that first current position scenario, are they on track? If not, we can then move to the planning solution and explain what we've done, why we've done it, and we can then amend as they need to. But again, clients often get in their mind the solution graph, but we have to then pin them back to action. And so we have to make sure that they understand that to get that graph, they need to do A, B, C, D, E, or whatever else it is. So when we have these graphs, what then do they mean to the client? So if in that top graph we have a situation where a client has a business, can your cash flow then be even more useful to you to say, well, actually, how much does the client need to sell the business for at retirement to be able to achieve their objectives? And these are calculations that most cash flow tools should be doing for you. And so you can really start using the power of that number crunching. It may be that we can actually rework that in a planning scenario and say, well, actually, if you were to sell your business now, how much would you need to get to it to be able to retire now? So do you want to retire now? Do you want to keep working? The value of that figure, if they keep working or selling their business at retirement, that then gives the client the understanding of whether or not they can just coast into retirement because their business is already hitting that value, or whether or not they need to be pedal to the metal for the next 10 years or whatever to deliver that early retirement that they want. When we have the second chart here, clearly the client has a significant amount of money at the end, over £1 million in today's terms. What does that mean? It means they may be able to spend more. And how powerful is it to be able to say to the client, actually, do you know what? In retirement, you could spend, do you realise you could spend an extra X amount? Or, you know, for those golden years of retirement, you can really enjoy them because you can spend an extra 15, 20,000 on holidays, really go and enjoy yourself and then cut back later as you no longer have the desire to go and see the world. And this is where, again, you can really be adding value to your client because, again, you could be saying to your client, with that amount of money, let me show you, you could retire now. Let me show you, you could be retiring in 3 years' time rather than 10 years' time. It gives clients choice and then allows you to work with that client to deliver their choice. Pension transfers, I mentioned it earlier. I'm sad enough to remember the pension transfers first time around, so to speak, where we transferred a lot of clients out of final salary schemes, and then we spent a large number of years and a huge amount of money buying them all back in again. It's always been a contentious area. I think it will always be a contentious area. So the more support we have to back our recommendations, I think the stronger position we'll be in. And the regulator, in fairness to them, are making it quite clear that they expect a high degree of suitability to be achieved. And when you're picking out from PS 18/6, so from last year, looking really at the client's financial situation and investment objectives is key, as is looking at other ways of meeting the client's objectives, and cash flow modelling will allow you to do that. These are your options. You can leave the money where it is. You can move the money. You can put the money here. You can do this. You can change your expenditure. And so by thinking carefully about your cash flow and your kind of cash flow scenarios, you can then pull those through, lock them down afterwards so that they're there for future reference. So that then if a client comes back in years to come, and bearing in mind also, you know, the SCA is saying you do have to be able to assess the impact of tax and access state benefits and crossing tax thresholds. Well, having locked down a cash flow scenario so it's there for you in the future, and that's one of the other benefits of it being within your main system. It's just held there for you. Then you can go back in years to come and say, well, this was the tax position, and no, it didn't prejudice them because of this, or actually the planning scenario produced you know, the staying put scenario meant they paid a whole lot of extra high rate tax, and here you can see the spreadsheet that shows that. But actually, in the planning scenario, the advice transfer means that you save them an awful lot of tax, and it was tax on money they didn't need. And so you can really start to focus in on that should you need to. So I think from a pension transfer point of view, there's some really good benefits. I've just had a couple of questions come in, so I'm going to be really honest with you and just have a look at some of the questions. I think what I'd like to do for Ross, I'd like to come back to those at the end if I may, Ross, and just answer them through at that time. But thank you for those questions. If anybody else has questions, then do please feel free to ask them, and we'll pick them up in a moment. So other regulatory issues. I think when we look at holding data, correct data is always a challenge. Certainly when I was sort of on the business side of the industry, working with clients, accurate data was was the holy grail. It was really what we were looking for. And the regulator, again, has made it fairly clear that our data should be up to date and accurate. And I think, again, Cashflow helps this. And it helps it because when I build a Cashflow for a client, I'm not just going to build it. I'm always going to keep an eye on the fact find and the information there to make sure it is correct. It's a double check. And that then means that if I've got errors coming through into the Cashflow, I know that my main client management system is wrong. Therefore, I can get that updated. That then means that I get more accurate information within the client management area, which is fantastic. I think the other point is it then means when I come to the review position, so next year, and I want to just print the fact find, I know that I'm printing accurate data. I can print that out, I can send it off to the client, and I can say, please can you update your income, your expenditure, your money on deposit, and away we go. And so the whole thing becomes a virtuous circle of data management. Drawdown reviews. Certainly when we look at drawdown reviews, the regulator expects us to confirm whether the drawdown is sustainable or not. And it's very easy within Cashflow to calculate that, hit the button. Yes, the sustainable drawdown is 15,000 a year. They're only taking 12. That is sustainable given the growth rates, etc., assumed. But I think also it allows us to widen out that discussion even further. And it allows us then to look at other ways of drawing down that income. And so we can really start using the benefits of pension freedoms, cash flow allocation, as I showed you earlier, to really unwind the financial planning. And while many of our clients may still be taking down a significant value from their pension, is that still the right advice? Can we show them that other advice would be better? And so drawdown reviews needing to quote that sustainability of income actually for me is a real financial planning advantage, is a real financial planning opportunity. Risk profiling. I think we all understand where the regulator is on this in terms of what we need to achieve. So we need to understand what the client's natural tolerance to loss is. And many of us will now use a psychometric type questionnaire, or you'll have other ways of establishing that. And so we get that view brought through. We also have to understand what the client's experience is. And that's really relevant. A more experienced client understands risks perhaps a little bit better, and therefore it enriches the discussion. And where I've seen Cashflow used for these next two, the need to take risk and the capacity for loss, it really, really enriches the risk discussion. I suspect, and I've seen, many clients don't have a real understanding of, well, what happens if I do change a risk band? What does that actually mean? What does that mean in terms of me achieving my objectives? What does that mean in terms of market drawdown or whatever? And therefore, having Cashflow to say, this is, okay, we think about some of the graphs we saw earlier, the one which had a lot of money left at the end. They had best part of $1 million left at the end. Now, they could spend more, absolutely. They could retire earlier, absolutely. They could take less risk. A Cashflow tool often, with the right tools, will help you, will actually be able to calculate how much less risk they need to take on their invested assets, which means that you can have the discussion that says, you don't need to take that much risk. Do you want to? And that's what the risk profile is all about. It's all about taking these factors into account, and they may well turn around and say, do you know what, I've been invested at that level of risk for the last 15 years. I'm very happy where I am. Fantastic, tick. We've taken them through the fact they don't need to take as much risk. We've quantified how much risk they could reduce by, how much they could reduce their risk profile by. And we've saved that scenario out as risk need 2019, lock it is there for posterity if there's any queries, because then if there's a market setback in years to come, you can show you've had the conversation and the client declined the opportunity to reduce the risk. You're no longer online. And similarly, with capacity for loss. So can they afford a market setback? And you can structure this to say, okay, fine, yep, if the market was to drop by 20%, because that's the kind of commensurate with the level of risk you're taking currently, if it's set back yesterday or tomorrow, what does that do to your money? And you can then show them that actually they can still achieve their objectives. There's no problem there. They have sufficient capacity. I've also seen it used in kind of as a spin-off in terms of saying, and actually, Mr. Client, I don't know where the market's going tomorrow. I know the market's just a little bit volatile at the moment, but do you know what? Actually, for you, it doesn't matter, because even if the market did drop tomorrow, then you can still afford what you need to do. And there are various discussions about how you should portray that market drop. I quite like the drop it at a point now or just before I take income or whatever, and you just have that drop, and there's then no built-in recovery. And the reason I like that is because I don't know when the recovery is going to come. Is it an 87 type market setback where the market was back in 2 years? Is it around the sort of 2000, 2001 market setback where actually it took up to 15 years? It wasn't until 2015 really the market came back. I don't know what the recovery is going to be. Therefore, for me to model a set sort of recovery has a degree of risk. I'd much rather be able to turn back to the client and say, do you know what? We assumed quite an aggressive position. The markets haven't dropped, therefore you're able to retire 2 years earlier. Isn't that fantastic? And so you can retire now, rather than having to say to the client, actually, I know you wanted to retire this year, but the market hasn't come back, and therefore, because we modelled it coming back, you're going to have to delay your retirement, or you're going to have to change your expenditure, or whatever it is. So for me, it's kind of quite an aggressive with no recovery, but that again is your choice in terms of your business positioning. So in summary, I would say, first of all, define your proposition. What do you want to deliver? Why do you want to deliver that? How are you going to make money from it? That will then drive what you want from a cash flow tool. Is it a very lightweight, quick, easy calculator, or is it actually looking to deliver full financial planning outcomes? Whatever you decide, you make sure that your cash flow delivery is scalable, i.e. you can repeat that every year so the clients can get the power without it bankrupting you as a business. And the final point there really is, let's deliver great client outcomes. The potential is very much there, but let's use this for our clients' benefit so they can see. We have a number of questions come in, so I'm just going to pick some of those up. So in terms, Ross has been asking, how many periods do we have in terms of that surplus deficit allocation? A couple of periods in our tool. You'll have to talk to the other vendors if you were interested in others. In terms of calculating capital sums required and maximum additional spends, this is functions that are this is dependent on your tool. It's one of the things that I personally, that's why I do cash flow. That's absolutely why I do cash flow. And therefore, those are calculations that I would look to have within the tool. And if you don't have those within, is it the right tool? I don't know. That's your business choice. So in our tool, what's the latest in output in PDF format? Actually, we output in a Word document and a whole series of spreadsheets. And I'm going to be very honest here. Perhaps I shouldn't be. Amy, who's coordinating this, will probably shoot me for this. But I was hoping to be able to show you the examples of that. But they're on my machine, and we had some technology issues, so I'm actually on hers. So I can't today. But that's something absolutely pick up with your IRESS account manager or through the sales team. Jenna, again, replying back to you, unfortunately today I can't, but what I would suggest is that, again, speak to your IRESS account manager or to the email the sales team. I'll be very happy to pick that up with you at a later date. I think what I would also say is, from this is an introduction to Cashflow. It was deliberately not directly IRESS Cashflow tools centered, but to kind of raise awareness of Cashflow and the Cashflow market and how it may be used. And I would urge you, if you want to get into more detail about what IRESS can provide, and we do have a very strong offering in this marketplace, to talk to your contacts. I'll be very happy to set up either a secondary webinar that goes into the IRESS Cashflow tool in more depth, or individual demonstrations as is appropriate. And within our IRESS suite of tools, we have a full IRESS Cashflow tax calculator. We also have some individual tools that are much lighter weight, that may, for instance, just be able to work through an IHT calculation, or just work through an investment outcome, or pensions at retirement, or whatever. So we have a whole suite of tools as is appropriate. I think as I've gone through, all the questions now, so unless there are any more questions at this stage, I'll look to close the call. But as I say, do feel free to follow this up with your IRESS representative, or email the sales team, and those market IRESS Cashflow, and those inquiries will then be passed on to me, so we can then pick up the next steps for you all. Well, I think it remains for me now just to say thank you very much for your time. I hope you found it useful, and please do get in contact. Goodbye.